What's going on, guys? I have 3 option plays for you using spreads that are currently really attractive. I'm going to give you these 3 plays. Make sure that you understand the first play, understand how I'm opening and managing this trade, and then the 2 other current plays are going to be very interesting to open up right now. I already have them open in my portfolio, so it's going to be Airbnb, Amazon, and first, I want to cover Coinbase. Let's get into it. So when I look at the cash flow, when I look at the balance sheet, when I look at the income statement, I'm like, okay, this company's worth something. But when I look at crypto, there is no cash flow. No cash flow. It's basically whatever someone else will pay for it. So what is it worth? Well, I don't know. As much as someone else is willing to pay for it, just like gold, okay? Some people love gold, right? In India, people like really love gold. In other countries, they don't like gold as much. In US, it's kind of in the middle, right? Some people have gold bars, but honestly, most people don't, right? So it really depends on the country. So what is gold worth? Well, it's a commodity. It's just worth whatever the price is globally, what people are willing to pay for it. Okay, but that's kind of like a question mark. I don't really know what it's worth because I can't assess its cash flow. But when I look at companies like stocks, I can actually understand that this company is overvalued based on like price to earnings or price to sales ratios or different ratios, right? Here, Coinbase doesn't have any price to earnings because, hey, this stock isn't that good. It doesn't have any earnings. It's losing money, okay? So this stock was trading at a 52-week high of 290, and many YouTubers were pushing this stock at 290, and I've never had it. If we look at my history, actually, you know what? I'm super transparent. Rather than like talking at you, I'm just gonna show you, okay? I hate when people like tell you, do this, do that. I'm just gonna show you. That's why I share my screen and share my account, even though it's sometimes uncomfortable. But as you can see here, I've just been doing call credit spreads. I ended up selling at 119, put options, made money there, Iron Condor, made money there. Actually, no, I lost money on this Iron Condor. It looks like I lost about $300, which is not a big deal. I did not blow up my account on Coinbase, and as you can see, I've been doing call credit spreads a lot. Anyways, without wasting too much time, let's go into Coinbase. I'm actually going to show you how to make money, okay? Coinbase call credit spreads. And the reason for it, again, is because this stock is in bearish territory. Look at it the 3 months, okay? It's negative 35.9%, okay? People are blowing up their money. People are very upset. But guess what? You can actually make money even when the stock is going down, and you don't need a lot of money to do it. So as you can see here, both of these positions have actually made me money. The reason why this says 0 means that it's fully decayed. So whatever I sold this option for, this spread for, it's fully decayed and I made all my money. As you can see, $395 gained and my collateral is $6,500. So super small account friendly. If you have a few $1,000s, well, you can make a few $100s in just a week. So actually, I opened up this position 12.9 and 12.16 very recently during my live trading call. Let's see, I opened it up on November 28th and then November 28th. Okay, so November 28th. So it's been about 2 weeks, which is pretty good because 240, actually, let's look at this position before I fully show you the example. So this is a $400 spread, okay? I did 10 of them, so this is $4,000 and I made 240. That's about a 6% return. And this is in about 2 weeks. So in 2 weeks, 6%. That means in 1 month, it's about 12%, which is exactly what I told you in the beginning of this video. I was making like 12% returns month over month for like a whole year back in 2020, which absolutely skyrocketed my account because I more than doubled it. And I went to almost $1 million by the end of 2020. And then in 2021, I passed a 7-figure amount. So I'm gonna show you how to do this on Coinbase, but I'm also gonna show you my other positions on Airbnb and Tesla because I think you can really benefit. Okay, no matter what size account you have, small, medium, big, doesn't really matter. My Discord community helps everyone. I really specialize in small accounts because that's just naturally where everyone is. If you're a millionaire, you probably don't really need me. You probably already know what you're doing. And if you have a small account, then you're trying to grow it. So that's kind of where I specialize, and medium accounts as well, because there's a lot of medium accounts out there that want to get to the large account mark and they're trying to do it themselves. They're not as consistent, and that's what I'm here for. So sell call. Okay, I'm going to go from not December 9th. That would be tomorrow, okay? Now, here's a piece of advice. You don't really want to trade very short-term options. You can. Sometimes I do sell 0 DTE put credit spreads. In fact, if you want to see a video on that, just let me know. I can show you how to do that on QQQ and SPY. But honestly, typically I'm selling like 2 weeks out, maybe 2 to 3 weeks out, okay? So here, I'm just gonna go out until actually January 20. No, actually January 6. That's about 30 days out, okay? 1 month option, 4 weeks, 2 to 4 weeks is perfect, okay? So I'm gonna go to sell call option. Okay, I'm bearish on Coinbase, but that doesn't mean
Just because I'm bearish and I don't think this is an amazing stock, it still doesn't mean that I'm going to sell a call option at just 43, right? Because that's also not that smart. So, just because you're bearish on a company or you don't think it's going to rise that much, doesn't mean that the stock can't have short-term volatility and end up spiking up in price in the short term, and that could really, really hurt you. So instead, what I'm going to do is, I don't want to go 43, because if I expand this option, check it out. It has a, bid and ask is pretty good, okay? This is a good option to trade, okay? But check it out, the delta is 0.54, meaning that I'm going to lose 54% of the time if I end up selling this option. That's not that good, that's not safe, and that's not consistent. Instead, I'm going to go out of the money. So I'm going to go up. I'm going to keep going up. I like to look at chance of profit on Robinhood, but I'll have a link for you in Robinhood below. Not that I like promoting anyone else or having any affiliates, but so many people keep asking me what brokerage am I using, so I'll just add it for you in the description. But it doesn't matter what brokerage you use, because it's basically like a vehicle. It takes you from point A to point B. I don't care if you're using Robinhood or Webull or TD Ameritrade or really anything, Interactive Brokers. It doesn't matter. Okay, I'm teaching you the skills to make money, guys. You're gonna be loaded with cash if you follow the logic, the skills, the way I trade, the technicals that I'm using, the fundamentals that I'm using, everything that I teach. If you're watching my videos, you're gonna get wealthy. But it doesn't really matter what brokerage you use. That's totally up to you, okay? So I'm gonna go up, and I like to see about 85, 88%. So let's see this. Let's see this option right here. If I expand it, 53, 25 delta. That's still a little bit high for me, okay? That's still kind of too close. 25, that means about 1 out of 4 times I'm gonna lose. So I wanna go up a little bit more. Let's look at this, 21%. Oh, that's pretty good, okay? So that's about me winning 4 out of 5 times, and 1 out of 5 times I'm gonna have to close and roll this position, which I have a video on as well. I'm gonna link it in the description about rolling options, but 21 delta. Okay, this looks good to me. Oh, wow, guys, look at that implied volatility. Okay, so look, the implied volatility is really important. Just so you understand, the higher the implied volatility, the more premium on the option. The more premium on the option, you should be smiling, because that means more money for you, okay? You're gonna have more money in the bank account when you sell options, because when they're worth more, you collect more. If the implied volatility was really low, that wouldn't be that good. Basically, because then the premium would be super low, and then there would be no money. So a lot of people are like, oh my God, there's a lot of volatility. Well, actually, as an option seller, I love volatility. Like, it's literally like the best thing ever. Like during the crash in like 2020, I actually ended up making really good money on Tesla. I spotted it at a low price, got in, and things were great. But look, so coin, 96 implied volatility. I'm gonna go ahead and sell this. Okay, so I'm gonna collect $120 here. Now, if you just sell a call option, that's gonna be an unlimited loss. I would never, ever recommend just selling a call option, okay? That's awful, because you have unlimited loss. That's very risky. And also, most brokers won't even let you do that. I've never sold a naked call option, because that's not good at all. I've never seen any professional do it either. So just don't do that. Instead, what you're gonna do is you're gonna sell one call option. Now you're gonna go ahead and buy another call option, okay? This other call option is gonna protect you, okay? It's needed for protection. I typically stick to about $500 difference in strike. So from 55 to 60, okay? That's $5 difference, meaning then you only need to put up like 500 bucks worth of collateral. So I'm gonna go ahead and buy this, okay? Now you will see that my max profit is $51. My max loss is $449.
All right, guys, so that was a really important example. Now we can talk about the 2 positions that I currently have open. The first one is going to be Airbnb. Okay, Airbnb is a very interesting stock. I've been looking at it closely for a long time, and I specifically think that there's a lot of competition. So this strategy benefits when a stock doesn't go higher, okay? So if I go to the chart right now and I look at the technical analysis, you will notice that Airbnb goes up a lot and then it goes down, okay? So on this company right here, I think that they have a very strong resistance at around 127. I see that because I'm looking at the Bollinger Band. The Bollinger Band right here is expanding, and that's because Airbnb volatility is going up. That's exactly when this Bollinger Band expands, is volatility higher, Bollinger Band expands. When the volatility is lower, then it basically contracts, and that is not as good because you want it to be wide. This is safer. This means that this is capturing a lot more potential movement in Airbnb. So look, this stock took a nosedive from 127 down to 106. And that's why my current position right here has benefited a lot. But Now that it's expiring, what should you do? You obviously can't open up a 145, 150 because this position is already up 97.5%. So let me show you what I would do instead and how I would position and open up a call credit spread, including what I would do after, because the management is really important. Okay, so currently Airbnb is 106.60. I don't expect this stock to heat up, or I also don't expect it to really have any more further dips. I do expect this stock to go pretty much sideways, but if it does heat up, it could go back up to its moving average of 116. That's why I have moving averages, guys, because you can't predict the stock market. Nobody can, but my best estimate would be that if this stock heats back up and starts to have some positive momentum with investors coming in, then those investors are likely going to buy up the stock up until around 116. Now, stocks do overreact, which is why I'm saying 127 could be the high, but you know, that's not always likely. Going from 106 to 127 would have to be a really big catalyst, which I don't really see in the near future. Of course, I could be wrong. So going to opening up this position, you can see that right now, I actually have two different positions. They're actually both call credit spreads. Now, the first one I was showing you, I already made a lot of money on it. Okay, Airbnb, I'm already up on this 145, 150 call credit spread. I'm about to show you how I would actually open this position. But I also have a second position. This expiration date is a little bit into the future more. So this one expires on 6/16, and now this Airbnb call credit spread expires on July 21st. Now, it doesn't matter if you're watching this in the future. You basically just want to copy and paste my logic here of what I'm doing with options. Okay, so the next one I have is 130, 135, and this one still has some premium on it. But you will notice that my total return is $1,418. So I'm up a good amount, and since this one's already expiring, it is basically due time for me to open up another smallish position. Now, I'm not going to open up another 25 contracts because I already have 25 contracts. But what I typically do is when I have a good gain on my hands and I have a spread expiring, I'm going to be opening up another spread. So right here I have 7 contracts and these are basically worthless. I mean, they're only worth a penny. Of course, a penny is $1, but you know, I only have $7 here, so that's not good enough, okay? That's gonna expire, and basically already at this point, it's worthless to me. It's already made all the money that I wanted to. I could close out this position, absolutely, but there's no real point if this isn't really costing me that much collateral. Now, if you have a small portfolio, then yes, you would want to close this out, pay the $7, and then open a new position. But because I have a lot of buying power myself, I'm going to leave this position open and collect the $7. Either way, it's not a big deal, but on a small portfolio, I would lean on closing this position. On a big portfolio, there's no point of closing this because you get $7 free for basically just waiting a couple of weeks on a very tiny position. This is $3,500. Now, for some people, that's their entire portfolio. So then, yes, you would close out this position. But for big portfolios, you'd leave it open. Now, let's go ahead and open up a new position, okay? So I just said that the top is 127. So that is the area that we're going to be eyeing, okay? We're going to be eyeing around that 125 strike price, okay? So I'm going to go to sell call option. Again, I'd never just sell a call option. That would be a naked call sell. That is super risky. I actually do have this position open in my other portfolio, but it's a very small position, and that's only because I want a little bit higher risk personally, but I would never recommend this to any of my Discord students. In fact, I tell all my Discord students not to even use margin, not to use any naked positions ever, unless they're really in the program for about 6 months and then they start getting to that $5,000 to $10,000 a month mark. Then at that point, I understand. Because if you're making $10,000 a month, which many of my students are, over 2,000 of them are either trading part-time or full-time, then you can start getting a little bit more risky once you know what you're doing. But if you're just watching this video, I appreciate it, but please don't use any naked call sells, and also please don't use any margin. Now, for an expiration date that I'm gonna pick a future expiration day. So I can pick June 16. I can also pick July 21st. Now, to be honest, guys, there is a lot of benefits to shorter term options, but there's also plenty of benefits to medium term options as well, especially for spreads. Because every time you sell a spread or buy a spread, you are getting charged, even if you're using the free platform Robinhood, which I'm using. There's also a link for Robinhood down in the description, which gives you more access and more privileges with my link, but it doesn't really matter because even if it's completely free, there is still some implicit cost, okay? So there's explicit cost. For example, there's like a 65-cent fee on most brokerages, but for Robinhood, there's no fee. However, check this out, okay? First, let's just pick our strike price. So let's just say that I want to go around the $127 mark. So I'm going to go for 125. Let me expand this right here. Now notice the bid is 135 and the ask is 149. So basically all day, if you were to be buying this, you'd be buying it closer to 149. If you were to be selling this, you'd be selling it closer to 135. So you are losing $14 per transaction in theory. Now, it doesn't actually play out that way. The actual cost is somewhere in between. So the difference here is $14. You're probably gonna get executed for something in between. So let's just say you lose $7. So if you were to do this all day, you're losing $7 however many times or however many contracts that you're opening up. And that's why I always recommend that you don't do short-term or 0 days to expiration trading unless you have a bigger portfolio. For me, I'm just not a fan of using small amounts of money for 0 days to expiration trading because this is exactly what happens. You basically are getting charged about $7, and if you do that every single day, then you're losing $7 per contract. And you're not opening one contract, you're opening up like 5 contracts. So you're basically now losing $35 a day. I mean, that doesn't make sense to me. And that's why I'd rather open up an option that's expiring a couple months out if it's a spread, especially because the point of spreads is to grow a smaller portfolio. If you have a huge portfolio, then you don't really need as much spreads. You can just go with the bread and butter strategies that I teach, like the wheel, selling puts, and covered calls, which I have the best videos on YouTube on. By the way, if you appreciate me making videos, the only thing I ask is that you smash the like button because that really helps me out personally and it motivates me to make more videos. It motivates me to look at the comments and to take your feedback to make the actual videos that you guys ask for when you smash the like button. And if you don't smash the like button, then I'm just gonna keep going to the gym and make less videos. But I love you either way. So check it out, 125, okay? We're gonna go ahead and sell this, okay? The reason again I wanna sell 125 is because the top of the Bollinger Band is 127. I think 125 is fine, okay? This is just a preference. You can also go for 130 if you want lower risk. I always tell my Discord members this. When I open up a trade, yes, it's cool to copy my trades. Yes, you're gonna make money, right? But sometimes my trades don't go well. Sometimes I lose money, and that is perfectly normal in the world of trading. So I tell a lot of students that, hey, if you are less aggressive than I am, then go a little bit higher. So if I'm opening up 125, 130, then you open up 130, 135. And then vice versa. I also have students that are like, I have plenty of money or I have more risk tolerance and I want to be more aggressive. I need this money. I want to make more and I'm ready to take higher risk. Okay, in that case, then you would sell the 120 call option and then you would buy the 125. So I'm gonna take the middle ground approach, okay? I'm gonna go for the 125, again, expanding this option. You can see that the delta is 0.17. The theta is 0.04, which is pretty cool. I mean, that's like $4 a day that you're making on this option right here. The implied volatility is 38. The volume is not as high as I'd like, but it's not bad. And the open interest is very, very good. So I'm gonna go ahead and sell the 125 right here. Then I'm gonna go ahead and buy the 130. Now you will notice that, first of all, this position follows pretty good criteria for my Bollinger Band analysis. Now, Robinhood is kind of glitching right now because it is Sunday as I'm making this video, but if I actually do that one more time and I go to sell the 125 and then I go ahead and buy the 130, it is not letting me, but let me try the 140. Okay, really weird that it's letting me do the 140 but not the 130. All right, but anyways, let's just do 125, 140 for example purposes. You can see here that I'm collecting $109. Now, I'm actually risking a lot more than I want to here, and that's because it made me go from 130 to 140. So in all reality, this would actually be a little bit less than $500. So I'd be risking about $100 to make roughly, I'd be risking around $450 to make roughly $100 or so. Okay, so that return to risk ratio is really good. Now, this return to risk ratio is also pretty decent, and I would still open up a position like this, but me personally, I do like to stick to $500 spread gaps. That way, if I'm dealing with a smaller portfolio client, they have $5,000, then they can open up 10 positions, which are $500 each. All right, so the next thing that I really want to talk about is going to be Amazon. I think Amazon is a really good bread and butter trade for me, especially using put credit spreads. So For Amazon, I've actually been trading put credit spreads for quite some time. Amazon as a stock has shot up quite a bit. In fact, in the past 12 months, it is up 12%. Excuse me, in the past month, it's up 12%. And this is a good stock to be selling put credit spreads on. However, since it is high, it's getting riskier to sell the put credit spreads on. But I want to open up my position for some reason. Robinhood is not showing it at the moment, but as you can see, if I go to my history, I'm going to show you exactly how much money I've been making. Now, the way a put credit spread works is actually very similar to a call credit spread, but it's the opposite. Okay, so you're going to be selling one put option. That's cool, right? We're going to sell a put option. Let's actually expand this right here. We're going to sell a put option at 97. Okay, that's a whole lot of money. But now we're going to buy another put option at 93. So you can see how I made this trade on May 10th, basically going out 30 days. Okay, and this right here is a $3 gap. Excuse me, it's a $4 gap. So it's $400. 5 contracts, that's $2,000 worth of risk, right? That's $2,000 worth of collateral. Very small account friendly. Now, 160 divided by the $2,000 is roughly an 8% return. It's a bit higher because when you take the $2,000 and you subtract 160, well, that's actually the collateral that you're putting up. So it's not really $2,000. It's going to be $1,840. So when you do the math there, you're getting a higher than 8% return in about 30 days. And that's exactly what I'm talking about when you want to scale your portfolio. If you're making 8% return per month, that's basically about 100% return per year. Now, if I was able to do 100% per year return, I'd obviously be 5 times Warren Buffett. I would be 5 Warren Buffetts, and I would be 10 of the best YouTubers that you probably watch, right? Because all of them are fairly losing money because they're good at marketing, not actually at trading, okay? But that's not actually my return. I am not getting 100% returns per year. It is possible, but on average, obviously I have some losses. So my gains are typically around 4 to 6% per month because I want to be conservative and factor in some losses. Now, what do I mean by losses, okay? When the stock goes down, what I end up usually doing is the way I manage my position is I close the position if it touches in the money and I see that the momentum is negative, okay? So for example, if I'm holding Airbnb put credit spreads, which I wouldn't do since I don't like the stock, but as it plows down, say that I have the $113 strike, as soon as it hits here, right at 113, I would probably say, hey, I'm out because the momentum is very strong on the downside. So I would close out that spread and I would try not to lose the maximum amount that I'm risking. Okay, so then, you know, it would probably in most cases continue to go down. Or let's say here that it was at 124 and then I sold 115. If it goes down to 118, I may start to think about closing. I may not actually close. And the next day as it goes to 115, that's where I may end up closing. And then say on expiration day, it's at 109. Well, I get to avoid some of the loss and I get to close out the position a bit early. So I would play Airbnb, Amazon, and Coin because they have really good implied volatility. And good implied volatility means that you can collect a very good premium. If you want to follow all my trades and be part of my small account challenge, then make sure to hit that first link in the description. I'll see you in the next one.